Welcome to Talk Tickers, where we break down the earnings calls that matter. Today, we're jumping into BlackRock TCP Capital's Q3 results, ticker TCPC. And this quarter is a really interesting one, folks. It shows a company right in the middle of a big strategic pivot, battling some old issues while trying to build a much more solid future.
So here's how we're going to tackle this. We'll start with the headline numbers, then get into management's game plan for turning this ship around. We'll also dig into some of the risks that popped up during the Q&A, and we'll wrap it all up with our call on the stock and a pretty specific trade idea.
Okay, let's get into the weeds. TCPC's third quarter really is a mixed bag. On one hand, you see things that look pretty stable, but if you look just a little bit closer, you can definitely see some underlying pressure points. First thing you see, net asset value, or NAV. It held completely flat at $8.71 a share. Now, on the surface, that's good. It tells you the portfolio's overall value isn't eroding. But the earnings story is a little different. Adjusted net investment income per share, well, it slipped by a penny, down to 30 cents. Now look, that still covers their 25-cent dividend, but that cushion is getting a bit thin, and the trend, well, it's just not going in the right direction. But here's where things get interesting. The non-accrual trend. We're talking about loans where payments have stopped. And what you see here is a really nice steady improvement. It's dropped from 5.6% late last year all the way down to 3.5% now. That is a fantastic sign that management is making real headway in cleaning up the portfolio's problem children.
All right, let's pivot to what management is saying and how this new team is trying to position the company. They've actually been super clear about their game plan ever since they took the helm late last year. And this is that playbook right here. It's a really clear 5-point plan. 1. Fix the old problem loans. 2. Bring in better quality deals. 3. Use the huge BlackRock machine to find those deals. And 4 and 5, diversify and buy back stock. It's a solid strategy. It makes a ton of sense. The real question, like always, is can they execute? And this slide, wow. This just perfectly captures the tug of war they're in. On one side, a huge win with NEP Group. They went into a really tough restructuring and came out in a better position, upgrading their debt. That shows you what they can do. But then you've got Renovo, another deal they tried to fix, and it just completely fell apart. It's being liquidated now. It really is one step forward, one big step back. So what's the plan to avoid more Renovo-style blowups? Well, here it is. They're making smaller, more diversified investments on purpose. The average new deal this year is less than $8 million. That's way down from the almost $12 million average at the end of last year. The whole idea is to reduce the pain if any single company goes under. But, no matter how good the strategy sounds, the Q&A session really showed that the analysts, and let's be honest, the market, are fixated on the losses, not just the long-term vision. This is where the story they're telling ran into a bit of a reality check. And boom, here's the question that just cuts right to the chase. An analyst from Raymond James basically says, hey, why are these deals you guys supposedly fixed failing again so fast? I mean, that's a direct challenge to the idea that they've got this workout process totally under control. The CDO's answer here was, well, it was telling. He basically admitted that turnarounds are messy, they're hard, and they're not linear. And while that's totally true, it doesn't give investors a whole lot of confidence that we won't see more of these failed restructurings down the road. It just highlights how much uncertainty is still lurking in that older part of the portfolio. And look, this isn't just talk. The Renovo failure has a real, tangible cost. Management said straight up that this one write-down is going to smack their NAV for about 15 cents a share next quarter. I mean, that's a huge hit. It completely wipes out half a quarter's worth of earnings right there. So let's put this all together. What does it all mean for the stock? What should we expect next quarter? Time for our call on TCPC.
We are kicking off our coverage on TCPC with a market perform rating. Why? Well, in our view, the good stuff, the strategy, is pretty much being canceled out by the risks we're seeing in that legacy book. The bull case and the bear case just feel incredibly balanced at this very moment.
So our whole thesis is this. TCPC is in a classic tug of war. Pulling on one side of the rope, you have the new strategy, more diversification, better credit, the power of BlackRock. But pulling just as hard on the other side are the ghosts of portfolios past.
You've got failed restructurings, a guaranteed hit to NAV coming up, and even management admitting the road ahead is going to be bumpy. Okay, now for our outrageous but plausible trade idea. And just a heads up, this one's definitely for a more sophisticated investor who really gets the risks and wants to play the very specific dynamics we've been talking about. We're calling this one the turnaround straddle. And the idea is to make a two-part bet. First, you bet the stock sells off after the Q4 earnings report, when that 15-cent NAV hit is officially on the books. You could play that with put options that expire right after the numbers come out. But that's just part one. Part two is you bet that over the next, say, 6 to 9 months, the market finally starts to appreciate the better portfolio quality. For that, you'd look at longer-dated call options. The whole goal here is to try and capture that predictable short-term pain while also positioning for a potential long-term recovery.
And as we always say, this is not financial advice. Thanks for tuning in to Talk Tickers.